this Wednesday was they're still on track to reduce the interest rates 3 times. So that was like whenever the stock market has certainty about anything, it gets a little more confident. That it has a little bit more assurance that there's not going to be surprises. So that's a good reason for the stock market to have a little bit more confidence and to go up. So that was yes.
Yeah, go ahead. Sorry, go on. Yeah, that's fine.
No, go ahead. I wasn't saying anything.
So it seems like that they were on track. The inflation has been kind of more persistent than they thought it would. It's not really falling down, right? It's still at like 3%.
Right. It's hovering around 3.133 or so, and our target is 2.2% or something like 2%. So they got a while to go before it goes down to that. But someday I'll make that calculation for us so that whatever interest rate it is, like 5%, people are willing to pay 85% less for stocks at that rate. I'll make a calculation and we'll see if that works out over time. But the higher interest rates are, the less of a multiple people are willing to pay for stocks. So the price they're willing to pay. Next time the Fed reduces rates and is in an accommodative mode, we'll have to do that calculation and see if it makes sense, that our formula makes sense. All right. But I'm sorry.
Just kind of general news stories. The one thing that came out I thought was interesting is that the Ukraine food exports, the corn and wheat exports, have returned to kind of pre-war levels. They're able to ship it out through the Black Sea, which I don't think a lot of people are expecting.
Wow, that's great. And that totally is a huge input to inflation, because whenever the war started, that was one of the biggest causes of inflation. We had oil prices go up and we had grain prices go up. And there was that kind of kept those commodity prices high, which led to inflation. So that is a really good sign for the stock market. That piece of news right there. And so, let's keep an eye on grain prices over time and see if that helps our stock market at all.
Yeah, it's good for a lot.
Ukraine not really ship to the U.S., right? They ship to all over the world.
Yeah, no, they don't ship to the U.S., but it's a big deal for, I think, kind of Egypt and Europe, right. Turkey. So I think kind of internationally, having enough food, it's a big deal. So it's good news for a lot of people.
All right, let's look at what's happening with the S&P 500. This is the chart as of today. We've had like this since October 27th, or our bottom. We've had just a nonstop run up, and it's stayed overbought, and it doesn't happen all the time like this. And we're kind of in a jagged keep going up market. And right now we have the AI companies going up. So if you look at the market movers, we see AI across the board: Broadcom, Alphabet, NVIDIA, Broadcom. Yeah. So these are Jabil. These are all microprocessor kind of or stocks involved in AI. The ones doing the worst today, Lululemon. They had a bad earnings projections. So we'll go over Lululemon later on today. Nike is going down. We have a lot of retail-oriented stories. So why is Nike down? it's a direct competitor to Lulu, and Lulu said they're forecasting sales that are less than expected. So Nike is an apparel maker, also very close to the kind of things that Lulu sells. So it's done in sympathy, maybe. And VF Corp, another apparel maker, they do shirts. They're one of the largest dress shirt companies. All right. We have a couple Boston Properties and realty company, maybe some stress in the commercial real estate market. I'm not sure. Okay, so that's what we get from the top 10 in both up and down. Let's look at the NASDAQ, and we have the same AI companies in the top 10. And the ones going down the most are, see Tesla go down again, Adobe, all right, Zscaler, okay, we see some, I don't see any combination there that's
interesting on the Adobe, because Adobe also use AI. I also have an AI product.
Yeah, you're right. The one issue with Adobe, they had earnings out. We talked about this last week. They're only growing at 10%, but they have a really high PE ratio. So what people are willing to pay for a stock, if you disappoint or if you have any hiccup in your earnings forecast, there's a chance that your stock will drop if it's priced too high. And this is a very high quality company. They're consistently growing at around 10%, but their PE is much higher than that. Let's look at the PE of Adobe now. I think it's around 50. Let me see. Okay, you can see, look at this right here in Adobe's chart. You can see back in August, September, October, there was support right where it's at right now. You can see. So this is an example of whenever a stock is like in free fall and it's going down like that, it goes down to where it had support in the past. Now, if it breaks where it's at right now, the next level is here. Next level is here, and then it'll go the whole way down to here, which is 332. You can see it broke all of its moving averages. So you have a 200-day, 50-day, 200-day, and 100. This is the 200-day. As soon as it broke this last week when we were watching it, it's like it doesn't. The only way it can find support is these past level where it bounced, it bounced, it bounced, it bounced. So let's look at the Adobe. Look at the key statistics. It says the P is 30, so it's only grown in 11 or 10. So it's 3 times overvalued. It could drop 500 divided by 3 and it'll be fairly valued. So I guess it is an AI company, but right now it's being punished for that bad earnings projection. So so it isn't going up with the AI today for some reason. Okay, but let's look at the sectors that are going up and down. The ones holding up the best today, semiconductors, all these AI companies. We have technology, utilities, healthcare. Okay, so if we look at our statistics for the different sectors, we can see that the healthcare, look at the healthcare sector, XLV. This is the only sector that's basically oversold and at the bottom of its channel. So it's in an upward channel here, but it's oversold. So I expect, at least in the next week or so for the healthcare stocks to be doing better than the other stocks. That's kind of why today we had the healthcare as one of the better sectors. The healthcare right there. Okay, so let's look at some of the here's something I found. It's time in the market, not timing the market. And that's what Peter Lynch said, I think. And time in the market beats market timing every time, as Warren Buffett said. So I like this because I'm like a buy and hold person. And it's really hard to know when to get in and when to get out of the stock market. And whenever you sell a stock, thinking you might get back in at a different time, it's really hard to time that, because a lot of times whenever stocks are selling off, the 7 of the 10 best days occurred within 2 weeks of the 10 worst days. So if you sell off, a lot of times sell-offs are met by stocks going up a little bit later. And it's really hard to predict that. If you miss the best days if you miss the best 10 days, the amount that you return or returned goes down like a lot. And if you, let me see. So you miss the best 10 days, miss the best 20 days, the amount that you make, miss the best 60 days, you have a negative 4.2 return over this time period. So, so in general, my strategy in stock picking is just kind of buy good companies, and they're going to be fluctuating up and down mostly until their PEG ratio is 1. That's kind of like a bottom, and you have to be willing to buy and hold and go through the volatility to get returns that are better.
So Greg, I think it's been a while. I think I've internalized this chart here, right, quite a while ago. The recent thing that I guess I still struggle with is the current market behavior, which is these 4 stocks, these 7 stocks are 90% of the gains, right, this year.
Right.
And so that's one reason I'm like an index fund, and whole market index fund type investor, is because if you don't get those stocks, if you're picking stocks, it seems very frustrating, right?
Yeah.
If you're in those stocks, it's great because then you get outsized gains, but you're also running a real risk that you miss if you miss 2 of those 4 stocks, you might really be out.
Right. Well, what I'm doing is I'm kind of looking at, half of the profits in the whole S&P are from the top 10 stocks, or like a good amount of the profits. So I'm trying to buy like profitable companies and, and kind of stick to that. It is a risk holding on to stocks. Like a big portion of my money is in Apple right now, and it's going down. And so it's underperforming like 10%. I think it's going down 10 or 12% this year so far. So yeah, you're right. You risk it in both ways, having big stocks and big positions in big stocks. But I've been trying to come up with formulas to find out if stocks are profitable. And a lot of times over time, they'll return like 10% on average. So, yeah, it is risky. So your approach is actually a lot less risky than my approach to buy individual stocks, buying just the sectors. And you can see with our ideas of rotating, we know every year. Let's look at our rotating.
Because I think that the big gains, the big losses, and if you miss them those days, then you really miss out the gains.
Yeah,
that's very historically accurate. I think there's a lot of evidence on that. I'm not sure, is the concentration of all the gains in just a few stocks, is that new? I'm not clear on that.
That's been going on for for a long time. There's concentrations in the big stocks going back to the 1920s and 1970s, like the Nifty 50 in the 1970s, and there hasn't been that hasn't lasted more than 5 years or so, and then another stocks take over. But I don't know, it's interesting. What we have right now is the top 10 stocks all have monopolies, and they're growing until the government stops them. And so they've been doing that for 20 years, and now all of a sudden we have the government trying to stop Google, stop Apple, stop Facebook, and Yeah. So right now we just have this phenomenon where we have the big stocks that are growing unchecked, like 10% a year or so, and the government's finally catching on, and pretty soon they're not going to make as much money, and they're not going to be able to grow at 10%. Then we have to like figure out a good way to get out of that. Whenever if they make them a utility, they're only going to earn like 5% a year if they regulate them so much where they don't make money. So we just have to look through the news and figure out if that's going to happen. But in the meantime, your strategy of sector is, it seems like it's easier than the stock picking portion, the approach that I'm taking, because you can see you have a little bit more of an edge whenever you can move around at the beginning of every year. You can see the sectors that have done the worst. Our little test from the beginning of the year is doing really good. The worst to the first. We saw the financials, we saw the healthcare, we saw utilities. They all did bad last year, and now they're starting to outperform. And rotating like that and making money and that's a little more conservative approach, and it's a little more it's safer, I think. So So anyways, let me go back to some talking points from for today. If we can see in our calendar, we had the Fed meeting this week, and they said basically they're on track for reducing rates 3 times. And there's all kind of news basically saying we're not going to have a recession this year. So it looks like we're going to have rates reduced, which is good for any company borrowing money, and it's good when rates are reduced. That makes anything high yielding more attractive. So if you have interest rates go down 1%, then it makes sense. People want to buy utilities. People want to buy high yielding stocks with yields. So that's why we see, in our stochastics, a lot of the high yielding things going up a little bit, like the utilities, the telecoms, and some of the high yielding stocks like Philip Morris or Altria. Okay, so let's. So we expect. So we have Easter holiday next week. So sometimes people get excited around holidays. It's not real. I don't know if it is a market holiday, half day or so. So we might have a little bit of excitement around there. But right now we're super overbought still. So I have a yellow caution. We have earnings starting up at the end of April. So that could be a kick in the pants for the market. We have Apple, Google, all the big tech stocks reporting right around the end of April. And we have another holiday in May. So if we look at our average monthly stock, we have these are some of the best months of the year we're going into. In our S&P, S&P is pretty much overextended right now. Okay, so let's look at our meeting notes. The 10-year and the 2-year are down 1%. And that's probably why the stock market went up this week, because of those commitments from the Fed that they confirmed 3 rate cuts. And so that sense of certainty, anytime the stock market has certainty in anything, it likes that. We're still overbought, and that's just an amazing time right now. It's not going down, it's just staying overbought. All right, so we have 80% of the S&P 500 are above the 200-day and the 500-day, and the 50-day. So that's like super. People are super excited and they're buying right now. And market breadth is excellent. That means the average weighted S&P, almost every index, the small caps, every major sector is kind of going up. in getting all-time highs. So that means we have breadth in the market, and that is good too. Healthcare, telecom, financials, and biotech are doing good. And let me see. And we have corporate buybacks that are helping the stock market. We don't have a whole lot of major catalysts for the stock market to go down. We have everything in government is pretty much staying the same. There's no major laws being passed to hurt the stocks. So usually nothing going on in legislation is good for the stock market. Right. So if we look at our S&P chart, this is, you can see we're remaining overbought, like a 90 on the stochastics, and we're at the top of our trading range. So looks like we're stuck in this up and down pattern here, and next stop is maybe down here, and then we'll go up here and up. So we still have an inverse correlation to the interest rates going down to the stock market going up. So they went down this week 1% to the U.S. Treasuries, and the stock market went up. So that still nothing has really changed in our variables in the stock market. Starting to think about buying some gold because of all the problems we're having with our country and spending money, and our country's in debt, and one way to protect against that is to buy something that's going to hold its value over time. So maybe that's why gold. Let's look at the gold chart. There it is right there. So you can see it's been sideways for like a year, and all of a sudden it's starting to break out just a little bit. I don't know anything about gold though, so I'm going to have to research that for next time. Fear and greed. We're greedier now than we were last week. So extreme greed means you have to take some profits off the table and don't buy. That's like everyone's piling in right now, and they're getting more greedy. Same thing with the AI sentiment. People are bullish, more greedy than last week. That's an indication you have to be very cautious. And the dollar is basically going sideways. It was going down for at least the last 10 years, and all of a sudden it's kind of going sideways. So that's like a no-op. It's like a something that has neutral effect on the stock market right now. So we can't get anything from that. If the dollar was going down, we could by 10%. We know the stock market, all the multinationals have better earnings by like 10%, but it's neutral right now. Okay, people are complacent in the stock market. This VIX is down to 12. That is like basically a multi-year low. So people are not buying protection on their positions, and they're very aggressive in their purchases. There's no fear. And we're at the super high paradigm. Everyone thinks the AI stocks will go up forever, and it's going to keep it going. So we have momentum in the stock market. People are at the new paradigm phase. No one's afraid of a capitulation. No one's buying protection. And if you buy protection for your portfolio now, it is very inexpensive. We just have one thing that could lead to a crash. We have some of the big tech stocks going down. I'll go over the charts a little bit later. We have Apple and Tesla. Let's look at Apple. Okay, Apple has been, we pointed this out, it's been in a sideways pattern, and it's probably going to stay like this for at least a year or 3 years or so, because they're basically trying to sue Apple for antitrust. And a lot of times, even though they might have to make them adjust the way they implement their app store or a lot of what they're doing, but that'll take like 3 years or so to go through this. Google's already been sued by the government, and they're making all-time highs now. So right now Apple went down 4 or 5% yesterday on that news, and they went down to this level of support, and they could go down to this level of support next, which is the low from last November. So it looks like they're stuck in this range. And what happened to Microsoft, whenever Microsoft had antitrust problems in the 90s, they put all their effort into fighting the browser antitrust issues, and they totally missed the operating system for phones. So they let Google take that market, and that very well could be what's happening to Apple. They're distracted by all this. They might not put any effort towards AI, and they might be distracted. So you have to kind of take away a certain amount of their ability to grow when they have this lawsuit by the government, because everything they do is scrutinized. Apple is like, they can't buy an AI company because they're going to be looked over by the government a lot more, et cetera. And so because of that, it just seems like Apple could be stuck in this range and not grow a whole lot. So that's what their earnings projections say. They're only going to grow at like 3 or 5%. All right, so let's look at some more of our meeting notes. Worst to first. Look at this. Energy is really doing good this year. It's up 11%. Healthcare up 7%. Consumer staples up 6%. And financials, it's up 12%. So that kind of matches the technology, which is still outperforming. We still have problems with utilities and real estate, and they're basically break even for the year. We still have our themes of AI revolution and weight loss drugs. Every day we see the AI winners in the top 10. So that happens to be like a good portion of the ones we're following. And okay, we already went over our top 10 sectors. Let's look over Dan Now's top picks for the year. Meta is up 43%, Amazon up 17%, and the XBI is up 6.6%. KWeb, it's still not doing good. It's negative 1.5%. All right, so worst to the first. These are XBI. It was not performing for the last 3 years, and it's starting to perform. This is the big news that happened yesterday or the day before. This has been widely expected. I mean, everyone knew it was going to happen before it happened, so I'm surprised the stock went down yesterday. But the big problem with this is they might have to alter the way Apple might have to alter the way they do their app store, the way they do their messaging. They might have to make things more open and allow competition on the iPhone, and that could reduce their profitability. So it's definitely not good for Apple, but Google and Microsoft both went through the same problem, the same lawsuit, and they made it. They're still making all-time highs. So the one big problem is they might be distracted and miss the AI opportunity. They might miss. They might not be as aggressive as they could to getting into new fields. So if they loosen the restrictions on their app store and a couple other things, instead of making a profit margin of 90%, they're going to make half of that. So they're going to be maybe 1/3 as profitable as they are now after all this is over. Okay, so we don't know about that. I'm starting to think over time I have to diversify away from Google and Microsoft and Apple, because it's they're making these rules these companies follow so that they don't make as much money, and that's not very predictable. Okay, so this is the other big story of this week. There was the Fed said that they would reduce the interest rates 3 times this year, And they're coordinating that with the rest of the world's biggest central banks. So there's going to be a global liquidity. They're going to be all cutting at the same time. The Bank of England, the European, a lot of the Western countries that are kind of working together, they're going to be reducing rates together. So that's going to help the global economy. That'll probably make oil go up too, because there'll be a higher demand for oil. So that's another reason why oil stocks could go up. Okay, so that's good to know. We were looking at this Lululemon a couple weeks ago, and we were saying that's interesting, but it's pretty expensive. It went down 11% on a disappointing outlook. So the way stocks work, if a company meets earnings or beats earnings, even though they beat earnings or meet earnings, if they give a bad outlook, that trumps anything good that they gave in their earnings report. So they had a good earnings report, but they said the outlook is going to be less than expected. So whenever that happened, all of the retail stocks that are similar to this go down. Like Nike went down. We saw all the retail stocks in the top 10 go down. So I said, it went down 13% in the end this day. So I said, well, let's look at that again and see if it's, let's look at the top market movers. Lululemon down 14%. Okay. And you can see the other ones that are related to that are Nike and, okay. All right. So let's look at Lululemon. This is a example of this. The theme for this company is they have their clothes made in China for like a very low cost, and like maybe $1 a piece, and they sell it for $80 or $90 for retail. So that's why they make a lot of profit. But they're only growing 10%. So let's look at their earnings projections and estimates. Okay, I divided these years out, and they're growing around 11%, and their PE is 33. So they're 3 times overvalued. So whenever a stock has a bad earnings report or some bad news, they could drop up to 1/3 of where they're at right now before they get a whole lot of support. Like in a really bad market, like a crash, they would go down 1/3. I mean, they would go down, divide the current stock price by 3. So that's why I said a couple weeks ago it's really expensive to pay that much for this kind of stock. And retail is very challenging right now too. You have all kind of competition. You have Nike. You have problems with distribution. You have inventory. You have people switching to Walmart, and buying clothes other places whenever there's inflation. Okay, so it's very challenging. I don't think I would want to be in this kind of industry. Yahoo Finance says the PEG ratio is only 1.42, so they think that this is growing at 15% or so. All right, so that's half. So basically they think it's 40% overvalued. The profit margin, return on equity are good. So this return on equity basically tells you that whatever they're making a profit on it. So they can have their clothes made for $1 and they sell it for $100, and they might pay middleman 30% of that. But right now they're having a problem. A lot of companies like DF Corp are having that same problem with inventory, trying to find steady people to buy their product. Okay, we have another news story. Chipotle. We've been going over this stock for the past couple of weeks, and we added it to our watch list. This stock is around $3,000 a share. They said they approved a 50-for-1 stock split, and we know that a stock split doesn't help the stock. It doesn't make a stock more valuable. It's It just makes you have 50 instead of 1, and its value is the same. So I thought it'd be interesting to go through and see the true value of this company. Right now, it's growing steadily around 18%. That is pretty good for a casual dining place. I think they invented the fast casual dining experience. And so they're growing at 18%, and their PE is 54. That is really high PE. So they're around 3 times overvalued. But you pay because they have look at this consistent growth over time. It's going up in a straight line. This is why Bill Ackman has this on his top stock list. I mean, this is one of his top 10. So now this is very similar to Lululemon, where it's really overvalued. And if there's any hiccup, they miss their estimates or whatever, it'll go down, substantially, up to 3 times where it's at right now. So if you divide 3,000, its current price, by 3, that'll be like 1,000. If it was trading at $1,000 a share, it'd have a PE of 18. So, and that would be fairly valued. But there are some companies that always trade at high valuation, like Amazon or Chipotle. So you might never get that. Like also, Costco is another similar stock. It trades at a very high PEG ratio, but it has consistent growth. So we're following this stock now. So we'll watch it split 50 for 1 whenever that happens. But Chipotle, let's look at their Yahoo Finance. So this kind of matches our estimates. The PEG ratio is 2.55. So with the PE at 54, let's do. So 54 divided by 2. Okay. They think it's grown around 21%, Yahoo Finance. So that kind of matches our 18% growth. So whenever our calculations kind of meet in Yahoo Finances, then we know we really have something. So return on equity, we know that they have a good business model when the return on equities are around 50. So they buy the rice for 10 cents and they sell it for like $6 or $10 for the burrito. I guess their biggest problem in the past year or two was the increasing costs of cheese and avocados and things like that. So they have to manage their input costs. I guess that's a challenge for them. All right, that was a good little exercise. I did a fidelity screen.
Actually,
yes.
Lucky probably not that happy with the split announcement. It go down.
So you don't think this is a good announcement? You didn't like to hear that?
No, the market actually go down with
to
the 800s now.
Oh, okay. Let's look at Chipotle. CMG. It's not in our top 10. Okay, let's look at the stock after they made the announcement, see what happens. So we see. Let's chart. Okay, so it looks like, it's a 1-year chart. Let's look at the multi-year chart. Okay, this is a super strong chart. You can see it's going from the bottom left to the upper right. It's at an all-time high right now, basically. So as soon as they announced their stock split, it went up a bit. So it stayed overbought. It hasn't really corrected. Has it? Last time.
When did they announce it? No.
They announced it like this week sometime. Like in.
So that's so. You saw it. A month chart would be more efficient.
So I think they did that. They did it because a lot of times the company splits its stock because they're confident of the stock continuing to grow. Now, if you had a stock that they weren't confident they're going to grow, then and they split their stock 50 for 1, it goes to 50, let's say, dollars per share here, and they start having bad earnings, then their stock goes to like $5 a share, and they might be delisted. Yeah, that's the risk when you split your stock, is you might be delisted if your stock goes to 5 or $1 a share or something like that. And so there's this kind of unwritten rule that if you're splitting your stock, then you know your stock is going to continue to, after the split price, continue to go up. So whenever you have a reverse split, that's bad, because a stock could be delisted at like $1 a share, so they have to make it 50, so that they stay on like in the stock market. So so I think it's a good thing for the stock to split. It allows investors, a lot of times people want to buy a share or 100 shares of a company, and if they can only buy like one share, that kind of, sometimes you don't even have $3,000 to invest. So people would rather buy 0 shares than to buy, one share at $3,000. So you get more of a investing. There's more people that are able to afford like maybe 100 shares of this, and they do that for the customer, so that maybe their stock is more able to be bought by the most of the public. So it's more of a shareholder. They do it for the shareholders, not for adding value to the stock. So does that answer your question? Right. All right. So okay. So what I did was I did a screen in Fidelity. This has one of the best screeners. And I did a screen for all the things that we're looking for in a stock, and I did a special search for PEG ratio, EPS growth, revenue growth, and the PE of the stock. And I basically sorted based on these fields, and I highlighted the stocks that are trading at a discount that's fair value, the PEG ratio less than 1. And then I looked at the ones that are growing too, and I tried to match up, some decent ones to look at. We've been looking at T-Mobile for a while. It says that T-Mobile's at a discount, and it's grown around 12 to 25%. So I thought it'd be interesting to look at that, the details on that. And I know Matthew was interested in Supermicro, and it showed up on our screener, believe it or not. So this is a large cap company because it's like 50 billion, and it says that its EPS growth is 50% and its PEG ratio is 1.5, and it was just added to the S&P 500. So I thought it'd be interesting to check in with that company. It's one of those stocks that is the best performer in the last year, so it's really hot AI company. I thought it'd be interesting to look at that one. Matthew, do you have any comments on Supermicro? No comments. Okay. All right. So let's look at T-Mobile. Okay, we know that T-Mobile is taking market share from Verizon and AT&T. I have averaged out their next years of earnings, and it seems like they're growing around 17%. If you average out, they're 20%, 14, 15%. That is really good for a telecom. A lot of times telecoms only grow at 5%. Or less, maybe 3 to 5% or no growth. But T-Mobile has like 14 to 20% growth. So what I did was I looked at their PE ratio, which is 17, and they're growing their earnings around 17. So the PEG ratio is around 1. So so it looks like, let's look at so according to this, it's EPS growth is 26, so this isn't really all that accurate, but their return on equity is 12, so they're growing at 12% according to that. So that kind of gave us, and it said its PEG ratio is 0.88, so it's 12% undervalued according to Yahoo. So so we have an average, we have a PEG ratio of 1. That's pretty good. And we can see Yahoo Finance thinks its PEG ratio is 0.81, so they think they're 20% undervalued. That kind of matches this PEG ratio of 0.88. Okay, so they think that Yahoo, let me see. They think that they're growing around 22%. So if they're growing at 22% and their PE is 17, that's undervalued by 20%. But their profit margin is good. Their return on equity is decent. It's 12. They do have a lot of debt, and they may have been punished recently because of the interest rates. But I guess they're going to pay this debt off over time. They bought a lot of companies to grow to the point where they're bigger than Verizon and AT&T. Okay, let's look at this other company, SMCI, Supermicro. First thing I see is the earnings estimates don't go out very far. They only go out from this year to next year. So that's kind of sketchy. We don't know. There's not a whole lot of coverage on this stock, so it's not very reliable. So that's the first bad thing about the company. You see that it's growing 50% from last year to this year and 30% from this year on. So that's around 40% growth. And their PE is 30, so they're growing at 40% average. So that's a PEG ratio of 0.75. So they're 25% undervalued. So if we look at their statistics, the return on equity is 30. The profit margin is like 8. So we have a lot of, we just have a lot of unknowns about the AI story. This is a company that puts together servers and hardware using the chips from NVIDIA. So they're more of a, they do the hardware portion of putting together systems for companies like Microsoft or companies that do a lot of cloud-oriented things. So I don't know. It's a sketchy company. It's gone up a lot, but if their earnings continue to go up, and they still have demand, it looks like it's a little bit undervalued. I wouldn't buy it because it's a little bit too sketchy, too small of a company. It's only $54 billion in market cap. I like to have ones that are a lot bigger than that. Okay. Is there any questions? Anything anyone wanted to go over this week? Okay. We're going to look at some of the stochastics. We do this like once a month. You can see we're overbought in our S&P, and almost every stock and every index are kind of matching that. The QQQs are also they sold off a little bit this week, and they're halfway between overbought and oversold. Same thing with the defense ETF. Now gold is kind of overbought, and you see XLY. This is the consumer discretionary. It's halfway between overbought and oversold. XLB is the materials. It's overbought. In XLC, this is stocks like Facebook and Google. They're overbought. And XLV, this is the healthcare. This matches almost every healthcare stock. It's oversold, and it's at the bottom of its channel. So I think every healthcare stock is going to be matching this. XLI, it's halfway. It's overbought right now. And XLP, you see, the utility sector it's in a downtrend and it's overbought. And this is the real estate sector. It's oversold and it's at the bottom of its channel here. All right, and this is the energy sector. Now we know that the price of oil has been going up, and was out of favor last year. This little jump from beginning of January, this January to here is 13%. But we're in this trading range. But if the central banks in the Western world reduce interest rates together, coordinated, that will make the price of oil go up, and that could help this sector because there's a higher demand for oil if there's economies around the world that are more active. All right, so we have EWZ. The Brazil ETF is oversold and at the bottom of its channel. Uranium ETF, it's kind of halfway between overbought and oversold. You can see these healthcare stocks are matching the XLV. They're oversold and at the bottom of their channel. Abbott is the same thing. It's at the bottom of the channel and it's oversold. And Alibaba is an example of a stock we have to stay away from. Anything China right now, just that no one's buying it and it's oversold and it's going in a downward channel. 2 weeks ago, we were following Google and it was oversold and at the bottom of its channel. Now it's like almost total opposite. It's overbought and near the top of its range. And now it's not the good time to buy Google. This is an example of a very high yielding cigarette company. They have this is Altria. They have a 9.5% dividend, and as we have 3 confirmed interest rate cuts this year, the demand for high yielding stocks go up whenever there's cuts in interest rate. That's why this one probably is kind of escaping out of this downtrend. I expect most of the high yielding stocks to follow that. Apple, we already talked about this one. You can see that it dropped 4%, down to this level. The interesting thing about Apple is it broke through all of its moving averages here. See the green, the red, and the purple? That's the 50, 200, 100, and the 50-day moving averages. And so the stock is basically relying on past support. Right now, it doesn't have anything else to go on. And it's probably stuck in a range for at least a year in this range. This is an example of a high-yielding stock that continues to go up, just like Altria. So this is paying like 8% or 9% dividend. And it's in kind of halfway between overbought and oversold and at the bottom of its range. This is an example of a stock that's oversold. It's a drug stock. And you see, this is Colgate-Palmolive. It's basically in an uptrend and it's overbought. CSX is at the bottom of its trading range right here, and it's oversold. Meta is, it's interesting. It's overbought. No, it's halfway between overbought and oversold, and it's trading at the top of its channel. And JP Morgan, all the banks this year are doing very well. And this is an example of a stock that's really overbought, and it's at the top of its channel, and it's doing really good with the interest rates coming down. They'll be more profitable. The banks are more profitable when like a yield curve normalizes. So they basically borrow short term and lend long term, and that's their business model. And whenever interest rates are in their favor, that helps them out a lot. Microsoft is hitting an all-time high, and it's overbought. And Pepsi is kind of stuck in this sideways pattern here. It's overbought right now. It was in a downtrend, and it just kind of broke out of that. Now it's just going sideways. Procter & Gamble is overbought, and it's in an uptrend right now. Starbucks is is actually in a downtrend. It's been in a downtrend for a while, and this is kind of the one that I would stay away from. A lot of times it'll take a breakout of this channel. If it goes out of here, then it'll start going up again. But there's a lot of challenges with this stock. I think the biggest problem is there are unions that are starting to make it less profitable, and they can't really expand into China like they want to. So this may have more warts than I want for a stock. Verizon, another example of a stock that's high yielding, and we had the interest rates confirmed to go down to this week. That'll allow stocks like this to go up. So this seems like all the high yielding stocks we're following are going up now. Visa is an example of a financial. So we said all the banks are going up. This is going up with the banks. This is waste management. This is an example of a stock that will do good in good economies and bad economies, and they have a moat, and they're very expensive, but they'll continue to grow in good times and bad. Whenever the economy in America does good, there's more trash being made. There's more money made for this company. And the theme for waste management is they're automating a lot of their activities, like the recycling of garbage, and that helps them out. Amgen, example of one of the healthcare stocks. It's oversold and at the bottom of their channel. So almost every drug stock we're following is in that same oversold at the bottom of the channel. And we're starting to follow Chipotle. You can see that it's in a super uptrend and has positive news for a stock split. And it's above all of its moving averages. So it's an example of a stock that's overpriced, but it's very continuous, 18% growth. Johnson & Johnson, another stock it's sideways, but it's oversold with all the drug stocks. All right, and let's see. Berkshire Hathaway, example of they have two good things. One, they're financial. They're considered a financial, and financials are going up. And the second thing is they're charging a lot for their insurance, the premiums for all the auto insurance are raising their prices. So that's going to make them more profitable, but they're overbought right now. MasterCard is going up with the financials. It's the same chart as the banks and Visa. eBay is kind of breaking out a little bit. It was in a sideways pattern for like multiple years, but it's overbought right now. This is Boeing. Boeing has never-ending issues with quality control. This is like, you never know if you're going to wake up and you're going to find another bad story about Boeing. So I would stay away from this. The quality is not going to allow them to make quality airplanes and sell them without being taken back and fixed. This is an example of one of the GLP weight loss drugs companies, Novo Nordisk. They're making an all-time high now. They're overbought. They had some news this week about possible lawsuits that people had side effects for their drugs. So that could make the stock go back down to here, maybe down to here. And Tesla is it's in a one-year downtrend. You can see that it's oversold and at the bottom of its trend, but they're not as profitable as they were last year at this time. So I'm kind of staying away from this one. NVIDIA, it's making all-time highs, and it's continuing basically to go up even today. So Eli Lilly is following this path of growing 30% a year. They're halfway between overbought and oversold, and they're top of their channel. And Ford is basically sideways. They're not growing a whole lot, and they pay a dividend, so they're following like a dividend kind of stock. And Costco, they dropped a lot last week, but they're still in an uptrend, and there's some support right here. You can see they're oversold. I guess this might be the lowest that Costco goes.